Buying whole life insurance should feel like a financial decision, not a magic trick performed by someone in a nice suit. Yet millions of people sign on the dotted line every year without ever seeing a full breakdown of where their money actually goes. We are talking about products that can cost you tens of thousands of dollars over decades, and the illustrations used to sell them are sometimes built more like marketing material than honest financial math. The scary part is not that these products are always bad. It is that you often cannot tell the difference between a good one and a disaster until it is far too late. Think of a complex life product like a vending machine where you put in $1, but a stranger decides how much you get back, when you get it back, and whether the machine was even plugged in this whole time. Whole life, universal life, indexed universal life. These are layered financial instruments wrapped inside an insurance contract. And that layering is exactly where the sleight of hand happens. The agents who sell these products are not always villains, but they are almost always compensated in ways that create a conflict of interest you deserve to know about. A commission on a whole life policy can run anywhere from 50 to over 100% of your first year premium, meaning the person explaining the product to you has a very loud financial reason to make it sound incredible. Here is the kicker, the illustration they show you. That glossy spreadsheet with your name on it, projecting beautiful growth over 30 years, is built on assumptions the company sets, not guarantees. The non-guaranteed column is doing enormous work in that document, and it is usually the column everyone ignores because the guaranteed column looks so much less exciting. Back in the 1980s and 90s, universal life policies were sold on projected interest rates of 10 or 12%, and people bought in dreaming of retirement fortresses built on cash value. Then rates dropped, policies imploded, and people received lapse notices on products they had been faithfully paying into for 20 years. History has a dark sense of humor here, because indexed universal life is now being sold with the same breathless optimism that was used to sell those older products. The caps, floors, and participation rates in these index products are moving targets that the insurance company can adjust, and they have every incentive to make adjustments that benefit themselves over time. An independent illustration is not paranoia, it is just asking for a second opinion before a financial commitment that could span your entire adult life. When you hire an independent actuary or a fee-only advisor to pull a policy's internal rate of return, you are finally seeing the real cost of the insurance inside the wrapper, and that number is often shocking. The misconception people carry is that because something is regulated and sold by a licensed professional, it must be transparent and fair, but regulation sets a floor, not a ceiling, for disclosure. An independent illustration peels back the policy loan provisions, the cost of insurance charges, the mortality and expense fees, and the surrender schedule. So you are no longer buying a story, you are buying a spreadsheet you actually understand. Practically speaking, if you are being presented with any permanent life product, ask the agent to run an illustration at the guaranteed assumptions only, and then watch the energy in the room change. Better yet, take that same policy number and carrier to a fee-only insurance advisor who charges you a flat rate to review it, because that person's paycheck does not move whether you buy or walk away. The discipline here is not about being anti-insurance. Permanent life has legitimate uses in estate planning, business continuation, and certain tax strategies. The discipline is about never making a 30-year financial decision based on a single illustration produced by someone whose bonus depends on your signature. Patience is also a strategy here, because there is no urgency in this purchase, no matter what the calendar closing pressure suggests. A policy that is right for you will still be right for you after you have had 30 days to get an independent review, run the math, and sleep on the numbers. At the end of the day, the size of the commitment matters as much as the conviction behind it. And shrinking your position until you fully understand what you own is always the wiser move. You do not have to be cynical about the industry, you just have to be the one person in the room who asked for a fee breakdown before anyone handed you a pen. The irony is that the products with the highest commissions are also the ones that most need independent scrutiny, and the ones where agents are least likely to welcome outside review. Your comfort with any outcome starts with your understanding of every input, and that understanding only comes from paying someone whose loyalty is to you. If you want help navigating any of this, whether that means real estate investing, home contracting work, or connecting with the right lenders, check out our links in the description below.